Thanks, Tom. How are you today?
Good. Jeff is the vice president of Merrill Lynch, Merrill Lynch Investments down in Provo. So we appreciate such a fancy guy coming to see us today.
That's a pretty big deal.
Jeff, tell us about yourself. Tell us what you do, where you came from. Just tell us about you.
Well, I'm a local yokel. I grew up here in Wasatch County. Graduated class of '93. Left for a few years to go down to Utah County and graduated from BYU. Started with Merrill Lynch in 1998, and during that time, I've seen some of the best of times and some of the worst of times as far as our markets and economies are concerned.
Yeah.
But so I've been doing that ever since then. I've had a lot of good experiences, and I'm married now, live here in Midway with my wife Heather, and 5 kids.
So one of the things that's going to be very important in today's show is we're giving away some concert tickets to Lady Antebellum that will be coming January 24th to the Energy Solutions Arena. And you can do that on our Facebook at Guild Mortgage, Tom Stone. The question that will put you as an entry in twice will be how many years you, Jeff, have been in the business. So quick, we're math guys. Let's see how fast we can do this. If you started in 1998... and we're now just creeping into 2014. How many years is that?
That'd be almost about 15 and a half.
15 and a half years. So we'll go with 15. So for those of you who are interested in Lady Antebellum tickets on January 24th, enter in on our Facebook page, Guild Mortgage Tom Stone. And if you know the amount of years Jeff has been in the business, 15, you'll get your name entered twice. Jeff, I've actually been quite excited about this topic because this is one, in my experience, that people ask kind of the most about. We've talked about credit. We've talked about certainly buying homes and real estate, building homes. We've talked about all sorts of things. We've talked about the economy in Wasatch County, all wonderful stuff. But when I ask people stuff that they don't know much about, when I ask people, what do you want to know really, it generally comes to investments. So I know I and probably a few others are excited to have you on here, so there's a lot of pressure on you today.
Well, I'll do my best to raise to the occasion.
With that is because we're a little bit nervous, a little bit unsure of what to do with our investments, with our 401ks, with IRAs, and we hear a lot of acronyms and a lot of things, but we don't know. If I were to start out with a question, what do you see as maybe or at least some of the biggest mistakes that people make when investing? What would you say?
There's a million ways of, and I think that's the biggest fear that people have coming in with investments. There's a lot of different ways you can mess it up.
Okay.
And but there's probably a couple.
Now that's what scares us, by the way.
That's definitely what's scary about it. And there's a lot about it that seems just really hard to understand. And quite frankly, a lot of it can be counterintuitive. And so
that's a big word for us. Tell me what that means.
Things don't work the way we tend to think that they do.
Oh, okay.
And so that can be a little bit scary. It doesn't always go logically.
Okay.
They talk about a market that acts normally, and that's not generally the case. And
a normal market.
And so
that's an oxymoron, isn't it?
It is a little bit, and so we're easily scared of that. But I think really there are probably 2 or 3 main things that I've seen over the course of my career that probably are really lead to the big mistakes, the things that really blow people up. First of all, I think is allowing our emotions to rule the way that we deal with our investments.
Now I even teach that emotion is part of money.
Mm-hmm.
So tell us a little more detail what you mean by that.
If you talk to economists, if you take a basic economy 101 class, they'll talk to you about 2 things that tend to control our actions, and it's fear and greed.
Okay.
And that exists within the market, and we saw during the late 90s, greed was a big factor in what was driving the markets. Everybody felt, there were comments that a monkey could throw a dart at a board and pick a stock and it'd be a winner.
Yeah.
And so we were in a period where we saw a lot of excess, and
This is the .com era
This
you're
is the
talking about.
.com era,
Mhm.
and we even see that a little bit even in 2006, 2007, as people rolled out of that .com era looking for a new investment, they rolled into real estate
Mhm.
and that
Mhm.
kind of thing, and
Yep.
and got burned again with the excess that was happening there. And
Yeah.
so we see this greed or this desire to make money driving the market, and that's that works with corporate America, that works with us individually, it works with government, and so that's one of those driving factors out there. And so if we allow that greed, or on the other side the fears, which we experienced in 2000 through 2002 as everything kind of fell apart,
Mhm.
and again in 2008, 2009, then we become fearful, and we allow the most recent experience, the last 6 months, the last year, the last 18 months, drive our decisions, whether those are good decisions or not. And so we become controlled by that emotion.
No, I have a
And
question real quick. I'm going to interrupt you. So when you said greed, that's such a negative word that I would assume many of us would say, well, that's not me because I'm not a greedy person. How many people do you see that are greedy?
And you're right. That's in its today's connotation. That's probably not the right word. Greed is typically meant that someone out there trying to take advantage of you,
Okay.
or take advantage of that situation. And so maybe that that typically there are very few individuals and people out there. Certainly they exist.
If we phrased it, I'm in it for me.
Yeah,
I got to do what's best for me.
Mm-hmm.
Something like that, maybe.
And financially, I think that makes sense.
Gotcha. Got it. Okay, I'm with you.
And so, I would say that's the first factor, is we allow those emotions to control our decision making, and then we are frozen in a negative situation, and unable to make the decision to do what we need to do in order to get our investments or our portfolio to recover from a crash like that, or to make the decisions that we need to get out of a loss, or we need to we need to move forward and put that bad experience behind us, recognizing that things have changed.
Now, wait a minute. What if I
different.
I call you up and I say, I don't want to ever have a bad experience. I never want to have a loss, and I want to just make money. Is that possible?
It is not.
Oh, well, what's the deal then? Tell me.
There's always that risk return relationship that we're dealing with. You can take the U.S. Treasury is what they call in the financial planning world the riskless asset.
Okay. Yeah.
And when they say that, they're talking about in terms of volatility and the ability to lose money. And I shouldn't say it's the Treasury bill. So we're talking, 30 days, 90 days, that kind of thing.
Give us a little more about what a Treasury bill is. We've
So
heard of it, but we don't know what it is.
So a Treasury bill is just a bond, or you loan money to the government for a period of time. So with a Treasury bill, we're talking very short term. The note that we typically look at is the 10-year Treasury, which is not a bill, that's a bond. The current rate on that's about 288, something like that.
Sounds good.
And that's kind of the riskless asset. That's, if you put your money in that, the idea is that number one, you have a guarantee from the government that you're going to get your money back, and they're going to pay you whatever that interest rate is.
There's the low risk.
There's the low risk. Now it is going to fluctuate. That's the nature of the beast. But beyond that, the only other thing you can do is that would be considered in terms of volatility and risk of losing money that you could use would be an FDIC insured savings account,
Which gives us a return
gives you a return of
0.1.
Yeah, and that's a pretty sad situation to be in.
Sure.
So if we're going to invest and our biggest concern is not losing money, then we're going to have to give up return, and we know that if you're earning at 1 or 2% even, you're losing money after inflation.
Let me give you an example. Let's say, and this is a true person that I met. I called her grandma. That meant she was older. I'm not going to define what that means in case someone might get offended by it. But this lady that was a grandma, her husband had passed away, and she had $250,000 in the checking account, and had that for years. And what they wanted was to have that money sitting there in case they ever needed it. So liquidity was important to them, and that was how her husband did it. She didn't know how to do any different. If a person like that were to come to you, let's say, okay, now I guess I better give an age. whoops, let's say, oh shoot, 70 years old. Sorry, Dad. 70 years old, and that's a situation that you have. What would you recommend?
And we have to be careful with that because one of the things that we look at in working with clients is what is your experience investing?
Mm-hmm.
And obviously, coming from a situation where she's never really had any experience with stocks or bonds or any of that type of investment, it's going to change the recommendation. She just is not ever going to be comfortable and at ease investing in a heavily weighted stock portfolio.
Mm-hmm.
And so, the idea would be to start out very slow and give her as much liquidity as is realistic. $250,000 of liquidity for most people is a little overboard.
Good point. Good point.
And so, we might pare that down to some level that initially she can be comfortable with and start slowly moving her into a more diversified portfolio that has the possibility of earning a little bit more money. And the odds are with a woman like this that's got $250,000, there's a Social Security check, and if she's she's borderline a Depression era individual, she's probably living on Social Security. So the needs that she's going to place on that money are pretty limited.
Okay.
And so security and liquidity are going to continue to be a major concern.
So does that mean you sit down and look at a person's budget sometimes? Maybe see how much they need for their annual expenses?
Absolutely. That's a huge part of what we do, just so that we can have a realistic conversation with a client about what their portfolio needs to accomplish and is capable of accomplishing.
Do you ever find yourself in a position, and do you take it, where you can see the person is living outside their means and you have an honest conversation? Is that your responsibility?
Absolutely. And the funny thing is we typically think about that with people who have little or no savings, and that can happen with people who are earning, hundreds of thousands of dollars a year. And so it's not something that's restricted to someone on a very tight budget. And so that's something we do have to sit down sometimes with clients and say, if you continue to spend like you are, you're going to run out of money.
So in a sense, you're saying to the client, you own this.
Mm-hmm.
I know you're coming to me to do this for you, but in a sense, you're the advisor.
Exactly.
Not the one that's going to say, I promise you this return. If you come to me, it'll happen this way. You're advising them as best you can. Is that correct?
Absolutely. I work in a world of probabilities.
I see.
I can't give a guarantee. I can look historically and say, here's what the market has done. Here's what this type of portfolio has historically accomplished. But things don't always work out that way. And so we work in terms of probabilities, and we can say if we do this, you have an 80% chance of accomplishing this.
So one thing that if people have come and talked to me, I say this. When I tell people historically speaking, and of course people come talk to me about interest rates on loaning money, I say historically speaking is a term that may be a thing of the past.
Exactly.
Simply because maybe from 1930 or 40 to 2000, maybe even that long, 1990 anyway, you could say, historically speaking, over 50 years is what's happened. But then 1990 something happens, and 2001 and 2004, and since then, it was explained to me that we now have a global economy versus a domestic one, and so there's so many more factors taken in consideration that are new from what we're. Am I going somewhere that's?
Yeah,
does this make
absolutely.
sense?
This and all those things factor in, and we always have to be careful because back in the 90s during this .com era, the argument was that everything's changed. Valuations are different now, and we had PE, or price to earnings ratio, is a one of the metrics that we use within our industry, and those metrics were 2 and 3 times what they historically had been, and the argument was that things have changed and we can now sustain those types of ratios. What we learned very quickly is that the market hadn't changed that dramatically, and that those types of metrics still had play, and so we had a reversion to the mean. And so some things don't change, but as far as that global economy, absolutely, what happens in Russia now affects us in the United States. What's going on in China has a big impact on us in the United States. The U.S. still continues to be the strongest economy and the biggest economy in the world, but we're seeing particularly China and India emerging, and at some point those economies are going to be bigger than ours. The question is how does that all play out, and how does that affect us? What is the effect on the dollar? all those kinds of different things kind of play into it.
So should I be looking to invest in China?
That's something that you definitely want to consider. There are a lot of different ways to do that, and so investing specifically in China may or may not be the right thing to do. But it's certainly that, definitely looking at your portfolio globally is important now. 30, 40 years ago, you might have gotten away with just being invested in the U.S. Today, we may need to look more globally and say, you know what, maybe it makes sense for me to have an investment that reaches outside of the borders of the United States.
Let me just break for 1 second for station identification. You're listening to KTMP 1340, your hometown radio station. I'm Tom Stone, and this program is sponsored by Guild Mortgage Company. Jeff, if I was 25 years old and wanting to do the right thing, what's my first step? If I'm a beginner at this, my income is starting, I do have a little extra. What's my first step?
I think the first step actually has very little to do with retirement and everything to do with security, and that's establishing an emergency fund, something that you can dive into, and typically we recommend at least 3 to 6 months worth of expenses. So in the event that something comes up.
Where does that go?
And that's going to go in a savings account. That's going to be something.
That's the 0.1% thing
That's the 0.1%. You're not looking to earn money on that. What you're looking for is liquidity and security.
Okay.
So that's going to be number one. And then the next step is obviously, if we're looking at saving for retirement, I would start with your employer. If they offer a 401k or some type of a retirement plan, that is almost always the best place to start.
Now, that just displaced you out of any business to make that offering of advice. Tell me why you just said that.
Simply from the standpoint that the nice thing about an employee-sponsored plan is it's easy. It's
right out of your paycheck.
It's right out of your paycheck. You don't think about it. If you come to me and you want to set something up, then you're going to have to write me a check, or we're going to have to set up something that's an automatic withdrawal from your checking account every month. And that's something that you're going to have to. It's almost like paying a bill. You're gonna, you're gonna have to do that, and so there's a mental process that you're going to have to go through. You're going to have to recommit yourself to it every single month. If you go to your employer and they've got a 401k, you can simply say, I want to defer 10% of my income into this retirement plan, and it comes out of your check. You never even see it come out.
Now, it's pre-tax?
Pre-tax.
If I were to give you a check every month, is that pre-tax?
No, it's always going to be post-tax. Anything that I get, for the most part, is going to come in after you've paid taxes on it. Now, you could make a, depending on your income, you could make a tax deductible IRA contribution.
Okay. So there are options.
There are options, but typically going through your employer is the best route.
Okay.
The other side of that is they're going to have a pretty general lineup of investments that you can use. Nothing too extravagant.
How in the world do you pick, by the way? They give you 14 pages and they say pick which ones you want.
Yeah. There's a couple of ways to look at that. If you're working with an advisor currently, call that advisor and ask him to make a recommendation there. If you're not, typically a 401. I do have a couple of 401ks that I work with, and my job on that 401k is to meet with employees and talk with them about what their options are and help them establish that. So there should always be some type of somebody working with that 401k plan or that whatever that retirement plan is who can give you some advice in terms of how you should invest. And most of them have a website that you can go through that will help you establish what your profile looks like and how you should be investing.
Let's say I established my 401k 10 years ago. And let's say I chose according to what I was doing 10 years ago. Is that something I should look at changing periodically or just stick with what I got?
I think it's probably good to look at it probably annually.
Annually.
And, too much, 401ks really are not designed, or any retirement plan is not really designed to be traded on a very heavily basis.
Okay.
And you're dealing with mutual funds, which are very diversified, generally speaking. And so
diversified simply meaning there's a lot of them in there.
There's a lot of, you're not going to get in an investment where you're throwing everything into one basket.
Tell us why a mutual fund is smart, since just in case someone doesn't understand the mutual fund idea.
So mutual funds have their place. They're not for everybody and they're not for everything. But the nice thing about a mutual fund is, particularly if you're starting out with brand new and you don't have a lot of money to invest, it's very hard to get your investment spread out broadly enough in a cost-effective way so that you don't
And risk averse.
and risk averse. And so what you're trying to do is, if you take $1,000, you really have the ability to buy one stock,
Okay.
and your whole net worth at that point in terms of that money is tied to what that one stock does.
Up and down, up and down.
Up and down, up and down. With a mutual fund, what you're going to do is you're going to invest in a mutual fund that might be buying anywhere from 50 or 60 different securities to north of 2,000 securities, depending on what their investment goals are. And so what it does is it gives you a cheap and easy way to get a broadly diversified investment. And and that's a good way to start. As you build a bigger portfolio, then you may find that there are other options that are, number one, cheaper, and number two, are more customizable to what your particular needs are.
So let's just kind of take it on. I think I'm kind of going by age here a little bit. If I go down to a 45 to 50-year-old person, where should I be looking? What changes? What do you see happens with your clients at that age?
Your focus changes a little bit. By the time you hit 40 and 50, retirement's not so far away that it seems like.
I'm 43, by the way.
Well, and I'm 37, so I'm there too. But we're not so far away from retirement that that it doesn't seem like a reality anymore. And what we tend to see is that becomes more and more of a focus. You're still very much in the building phase at age 30 and 40.
Yeah.
And so your investments will tend to be a little bit more aggressive as far as the way you invest. Again, but that all comes down on an individual basis. And so I'm speaking very much in general terms here. But as you continue to get towards retirement, so the older you get, generally what we see is that mix of investments becomes a little bit more conservative, is going to have a little bit more of a focus on income in order to ensure that you have the ability to meet your income needs as you approach retirement.
So here we brought up budgeting again, by the way. Okay.
And so that all plays into it. At 30 years old, you can afford. Nobody likes to lose money, but you have the capacity to deal with loss more than someone that's 60 years old and is 5 years away from starting to use their investments to meet.
So what is on the side of this higher investment, riskier place, and what is the side on the lower return? What do you when you talk that way? What are you talking about?
So when we talk risk, if we're talking our most volatile investments, you're typically talking about equities or stocks.
Okay.
So investment in companies, and they're great investments. It's great because we have a lot of liquidity. We can turn an investment into cash in 3 days. The problem with that liquidity is it creates volatility.
Okay.
It's not unusual to see a large blue chip company in America have 20 million shares trade in one day. And so that's a lot of money.
When they trade,
hands.
What's happening? Someone's selling, someone's buying?
There's always a buyer and a seller.
Okay.
And so, you're just having two people come together and
or maybe a 401k.
Exactly.
Okay.
And so that creates a lot of liquidity, but it also creates a lot of volatility. And so what we see is typically you're going to see a larger fluctuations in equities than you are in, say, bonds. Now that's not always true. Sometimes you'll see that relationship reverse a little bit, but bonds typically are going to have less volatility. And when we're talking about a bond, there's a variety of different bonds. There's tax-free municipal bonds. There's U.S. Treasury bonds. There's corporate bonds issued by.
So what am I buying? These are some corporate thises, and tell me what I'm buying when I buy a bond.
So when you buy a bond, again, it's very much like a CD, with the exception that there's no FDIC insurance behind it.
Okay.
But essentially, what you're doing is you're giving that company, your loaning company, $10,000 with the term that they're going to pay you an agreed upon interest rate over the course of, say, a 20-year period. And at the end of that 20-year period, you're going to get your principal back.
So we become lenders.
Yes. So we're lending to corporations or to America or to municipalities.
That may be a different view that some maybe other people may not have had.
And so, the reason that we tend to see less volatility with those bonds is because there are different guarantees isn't the right word, but there are different promises made with that. And so a bond has what's called a par value. It's what it's issued at. And, typically that's $1,000
okay.
for one bond. And so,
Is it an actual paper thing you get, by the way?
you can. They used to be. They used to hand you a paper, and you'd cut the coupon off
Yeah.
and send it into the company, and they'd send you your interest payment.
Mm-hmm.
Typically now you hold them in an account, and the money just shows up in your account.
Okay.
But because that has kind of a promised value on it, it doesn't tend to fluctuate as much.
Okay. Okay.
They can be a little bit more volatile, but and the shorter the time frame on them, the less volatility you see with
So a
them.
bond, you still can have you loaning to a company
Mm-hmm.
or even the government,
Exactly.
and they're saying, "Thanks for letting us borrow your money.
Mm-hmm.
We'll give you a fixed rate
Right.
of return."
Mm-hmm.
Or as a stock thing would maybe be more of a variable rate.
Yeah, you have no guarantee what your return will be with a stock. Now, some stocks do have dividend payments that are associated with them, but those aren't guaranteed either. You may or they can raise that, they can decrease it. They typically don't like to because that reflects poorly on the company. But if they get in a bind, they can cut that dividend payment.
I see. So I could get paid by interest. I can get paid by dividend. How else can I get paid?
Price appreciation.
Price appreciation.
And this is typically, when you think of stocks, this is what the type of return we typically think of. It's also referred to as compound interest.
Okay.
Whereas, so I buy a stock for $20. At the end of the year, it may be worth less, it may be worth more, all based on, hopefully, on the underlying fundamentals of the company. But it could grow from $20 to $22. And at that point, I've earned a 10% return. And the reason they call it compound interest is if I continue to hold that stock for the next year, my return is going to be based off the $22 and not off of the $20.
So I get interest on my interest.
Exactly.
Okay. I like that. Capital gains. I know that's an accountant term, but is that how I would show on my tax? Is capital gains? Tell me how capital gains works in your business and how it associates and how that works.
So again, that's the appreciation or depreciation that you see on the underlying value of what you bought. So again, in our example, if you buy at 20 and you sell it at 22, then you have $2 of capital gain that you're going to have to pay taxes on.
Okay.
And inversely, if you lose $2, then you have $2 of capital loss that the government doesn't really give you a lot of
Right.
benefit for.
So I'm a person who has now retired from my job. I've had a 401k or some sort of retirement plan for the last 20 to 30 years. I have a budget that I'd like to keep. What are my steps there? So here I am, or maybe I'm a year away. Maybe I'm getting close. Tell me what I should be doing to prepare for that.
Number one, I think the biggest issue is you should be as much out of debt as you possibly can be.
Okay.
Now
wait a minute. You've talked about budgeting. You've talked about debt elimination. I thought you just did stocks and bonds and investing money for people.
Well, we look at ourselves as planners. We sit down and talk with people, and if all I did was investments, I wouldn't be offering much value to my clients. What I try to do with my clients is sit down and say, here's the overall picture. Here's where we are today. Here's where we want to be 10, 20, 30, 40 years out. What do we need to do to get there? And that includes more than just investments. That's we're going to be talking about their home, their debt. We always try to put together a personal balance sheet for our clients to help them understand where they stand financially.
What's on that balance sheet?
They're going to have their investments. They're going to have the value of their home. They're going to be subtracting out any liabilities, which might include their mortgage, car loans. If they have unsecured debt with credit cards or that kind of thing, that's going to show up on there.
Okay.
But all it is just going to be a simple math problem that shows here's what I own, here's what I owe, what's the net number.
Okay. And from that net number, you learn what?
We have a good basis in order to say here's our starting point. It gives us an ability to measure, and we can look and say, okay, and you can pull pieces of that out. When we're talking specifically with retirement assets, we're going to pull out their portfolio, look at that individually and say, okay, this needs to grow by X amount of dollars. And we're going to try and track that along a line to see how well we're accomplishing that goal year after year after year. If you look at that every 5 years, what you're going to find is you're going to get out of balance, and you might, if you've gotten way ahead, you can cut some of the risk out of your portfolio. So we try and look at that at least on an annual basis, sit down and say, where are we versus where we were last year? What changes do we need to do in order to accomplish that? How well are we working towards getting rid of the debt that we need to get rid of? All of those sorts of things.
You're listening to KTMP 1340, sponsored today by Guild Mortgage Company, with Jeff Rasband from Merrill Lynch, answering our questions about our investments. Okay, Jeff, I have a question.
Mm-hmm.
You talked about a home being part of your net worth. But my experience has been the home I live in, I need a place to live.
Mm-hmm.
I'm not really going to sell that thing. And to get any equity out of my home, I have to get a loan on it.
Right.
So in a sense, my primary residence is not really a true equitable income generating asset.
Exactly.
So tell me how that fits in this idea of yours, where really it's not really net worth. It might even be paid for, which obviously goes with your get out of debt thing.
Mm-hmm.
But tell me how people think, hey, I've got 100,000 or 200,000 equity in my home, and they feel rich. But
yeah, so a home is an interesting asset to have, and that's maybe kind of a loose term for what a home is. Yeah. I typically, some people will approach their home as an investment. I don't look at it as an investment. It's
how many kids do you have again?
5.
You got to have somewhere to put them.
You
right?
got to have somewhere to put them. You got to live somewhere. And in our community, in this particular, the culture of our area, home ownership is kind of a big deal.
Mm-hmm.
And so, but you don't own a home because you intend to sell it 5 years down the road and make money on it.
And do what with it, though?
And buy a new home.
And put it into the next home.
Right. And so typically we don't look at it like that. You buy a home, the values we place around our home are different, but it still shows up in terms of our personal net worth as far as, and it might come into our planning this way. We're working and have our highest earning capacity, we might be more willing to own a larger home.
I see.
But as we approach retirement, our kids are no longer, I've got 5 kids now.
Mm-hmm.
My needs with my home might change dramatically as my kids move out of the home, and so I might look at downsizing. Mm-hmm. And so there might be some equity in that home that I can harvest and use towards retirement, depending on what I'm willing to do.
Let's go into real estate investing. So we've talked about our primary residence, but real estate investments would include rental homes, maybe land.
Mm-hmm.
Could be commercial real estate, some of those things. Tell me the viewpoint of yours and maybe your industry when it comes to real estate investing, in understanding putting your money here and putting money in a stock or a bond. Or tell me, what's the viewpoint of that?
Yeah, so obviously I don't do a lot with real estate.
Okay.
It's not something in the financial securities world that we deal with very much. I mean, there are a couple of things that we do that deal with it, but it's a totally different animal than what you typically.
Because really, some bonds, by the way, are mortgage bonds, right? So I guess in a sense,
so it's there, but it's really not in the sense of it's different than actually owning a piece of real estate. Mm-hmm. And so my view is this: I think a lot of it has to do with what you're comfortable with. Mm-hmm. Some people grew up in a real estate world; they're not going to be happy working with me for the most part. I have a couple of clients that do a lot of real estate types of things. All I provide for them is liquidity. They're moving cash in and out of their account in order to try and, just as they're buying and selling properties and that kind of thing. They don't have a lot of interest in owning stocks and bonds because it's not, number one, it's not something they understand. My experience has been, if you do real estate, you understand real estate, that's what you enjoy doing.
Mm-hmm. Mm-hmm.
The other side of that is that a lot of people who grew up on stocks and bonds don't have a lot of interest in real estate, and there's a variety of reasons for that. But my impression is for a person starting out trying to get into the investing world, real estate's an awful big animal to try and eat. Mm-hmm. As far as it doesn't lend itself to new investors, because there's usually a pretty steep cost involved in getting into it. There's always generally a lot of leverage involved with it. And so it may not make sense for someone who doesn't have a significant net worth to try and do that.
So you don't have a harsh opinion if someone says, I don't trust the stock market. I lost my, whatever you lose, shirt, coat, hat, tie, whatever you lose.
All of that.
All of that in the stocks. And I've and I put my money into houses, I like to be able to see what I own. I like to be able to walk in and this invisible thing that's on a statement, boy, it just makes me nervous. And you say, well, that's what you're comfortable with, is what I said.
Yeah,
What I just heard.
and you should always invest where you're comfortable,
Hmm.
because you'll be unhappy otherwise, or you're bound to have a bad experience. And so I do think as your net worth grows, it makes sense it may very well make sense if it's something you're comfortable with to diversify into real estate as well. I mean, that's just another piece of the puzzle out there that you can add into your overall portfolio that's going to help even out the ride.
So technically, what you just said, if I heard correctly, is if you get well enough planned and you have some money, maybe do some of both.
Absolutely. And there's no reason you shouldn't. Now, as you age, you might feel like the time requirement and everything involved with real estate is too big at that point, and so maybe you liquidate it. And it all factors into your lifestyle. For me in the industry with the comfort level I have in it, right now, real estate isn't that interesting to me. But I could see if my net worth grew significantly, I would want to diversify away from what I'm doing with stocks and bonds, simply from the standpoint that it's something that's out there. But I could also see by the time I'm 80 years old, I don't want to be a landlord anymore.
You just said something that I want to ask personal. Are you comfortable investing in these stocks and bonds that you sell?
Absolutely. And the most important thing in any investment is understanding the risks associated with it and being comfortable that you can't ever eliminate it, but you've minimized it to the extent that is possible.
So you have a 401k, I assume, and you've been able to do, I'm going to choose this stock and that stock,
Absolutely.
or that bond and that bond, and you diversify over the years. But you've felt that, hey, over time I've made money on this, where I can see my plan working accordingly.
Absolutely.
Now, you also mentioned at first of the show that you've seen a lot of the highs and the lows. Tell me how it felt personally and going to work. Let's say, what was the worst year? 2001, 2000?
The worst actually was the end of middle of August 2008 through about March of 2009.
Oh, okay. Tell me about that. Tell me what was happening. What were people doing? What were you hearing? What was the phone? Here's the phone ringing, and it's one of your clients, and what are they saying? What's going on?
The conversation is what's going on? Am I going to lose all my money? And that's one thing that's hard to really, it's easy to look in hindsight and say, oh, that was obvious, but when you're sitting in that moment, so the market turned, I think it was March 11th, March 12th, somewhere in there, 2009. And there was a lot of panic there because there wasn't anybody out there saying anything positive about what was, and this is where that fear, greed whole idea comes in.
And probability. They're not real facts, is what people are saying.
Yeah, and so what you've got is the news media saying, the industry is going to pot. We're already down 50%. We're almost 50%. We're going down 50% more. And people are scared to death. And that's where I really, as an advisor, earn my money. Is to sit down with clients and help them look at things rationally and help them remember why we set the portfolio up the way we did in the beginning. And a big part of that, one of the things that we were very successful with during that period of time is we had a good mix of investments, so that even though the market as a whole was down, our clients weren't experiencing the loss that the market was experiencing, and they were able to recover from that usually within about 12 to 18 months.
What was the normal reaction? The market tanks like that. People's reaction are to do what?
Most of them are ready to sell.
They want to sell.
They want to get rid of everything.
And your advice is? Stay
the course. And you might change your allocation. You may be allocating, and hopefully you're allocating along the way. You're not getting to the bottom and changing it at that point. And you're not making extreme changes. You're not going from 100% equities to 100% cash or bonds or whatever. But the idea is that we bought these investments recognizing that at some point we're going to experience a loss in them. And that's what clients have to understand. There's going to be a period of loss. 2009 was an extreme. That's a generational type of experience. We don't typically, see that steep and that deep for that long a period of time. So so what we're doing is we're talking them through why we bought those investments, why we need to hold on to them, because the fact of the matter is if you get rid of your equities at the bottom, you're going to lock in the fact that that's where you're going to be. And the real tough decision is not getting out of the market, it's getting back in. And that was the conversation we had several times is you get out, you've got to tell me when you're going to get back in, because you're obviously not taking my advice at this point. And so I'll be honest, at the bottom in March, there wasn't anybody with $1 to spare that was going to put that in a stock.
Let me ask this question as you're talking. I've been told, probably from you, that at the low time is when you should buy. Expand on that a little bit.
Well, generally speaking, you want to sell high, buy low. In reality, that's much more difficult to do, and that's one of the hard things that we deal with is sometimes our clients expect us to have inside knowledge or to be able to foresee these things happening in the market, and the reality is we don't. Maybe on a level we do. I mean, we all knew in 2007, 2008 that there were problems with the real estate market, and that was going to play out somehow. What we didn't have any idea of was how serious the problem was, and how that wouldn't just affect the real estate market, but it would be pandemic for our entire economy. And so we knew that there was some kind of sell-off coming, but we had no idea of predicting it would be 40%. And so, again, working with probabilities, we're saying, well, this type of a portfolio is generally going to offer this type of a risk-reward characteristic. And so we might have been able to, rather than experience a 40% loss, we might have been somewhere between 35 and 20, depending on how their assets were built together.
And that was actually a positive.
So
less loss.
Less loss.
And you have to look at that as a positive.
Well, that's not a very fun conversation to have. You're down less than the market,
Yeah, how fun was it to go to work those days, by the way?
Not fun. And I do, and this was actually, I remember experience I had and this was back in 2002. I had a client who was a young widow, and sat down. It was, we try and review each account at least monthly, individually look over it and make sure everything's looking good. And I sat down and pulled her account up and was looking through at it and just saw the loss in there, and it shut me down for the day. I had to go down and just lay on the couch for 15 minutes and regroup and then go back up and say, okay, how are we going to deal with this?
Because it's a young widow.
It's a 40-year-old widow, 5, 6 kids, and this is what she's got. And so
you felt the responsibility of it.
And so it's kind of a sickening experience sometimes to go and look at those, recognizing that there are dreams and goals and aspirations tied to this money, and you look at that loss and you recognize what that means to that client, and so that can be a really heart-wrenching and gut-wrenching experience.
But yet, there you are, the advisor, who says, hey, good news, now is the time to buy, if possible, and trying to see the positive spin on that.
And you do, and that's why it's so important that during those times we were able to push that emotion to the back and say, I understand.
Because I'm feeling it too.
I'm feeling it, that I've lost money here, but I also recognize that the best way and the fastest way to get that money back is going to stay the course.
I have a question. So again, I do mortgage financing for a living. You're doing stocks and bonds, financial investing, and in the 08-09 crash, I've said this before, and I want to say it to you and have your response. I've said it's always funny because we watch. On the opposite side of investments are people borrowing money. Maybe it's the same thing, but so interest rates and what's it cost to borrow money, and they go up and down just like what you're seeing on the opposite side. And it was interesting as we get reports coming each week that dictates what's going to happen in the market. And generally speaking, by the way, if it's a good market, a good day on the market, stock market, it's a bad day for me. Rates go up. So I've always said bad news is good news for us, because as the stock market goes down, people kind of flow their money over into these bonds that create lower interest rates. But the report that would come out each month saying, housing starts and construction this and stuff, most of the market would just kind of say, whatever, it's not that important. Then all of a sudden 08-09 shows up, and it was the absolute everything about real estate that made the thing tumble.
Right.
And then all of a sudden, and I'm like, how come no one's ever noticed this? and I don't want to take any ownership in the problem, by the way, when I say us, but the housing industry, and then all of a sudden it crashes, we're blamed for everything.
Mm-hmm.
And I'm kind of giving you a feeling of my industry, saying, wait a minute, a lot of us did what's right.
Mm-hmm.
A few did not. Here we are in this situation. What is the relationship to the fact that, it's separate? There's the housing market and there's investments, but yet housing was the reason, they're saying, that it crashed like it did. Tell me how that's related.
Okay, so what it came down to is a big part of the problem was the subprime lending industry that existed back then.
Let's make sure we know what subprime means. I'll do that.
You do that. That's your industry.
Subprime is people who are riskier, bad credit, no down payment, spec houses that were rental houses, so riskier financing, and they were giving money to them pretty easily.
Mm-hmm.
So subprime, prime is the best loans, and if you're subprime, then you are loans that not as desirable, that you generally pay a higher interest rate on, which is a higher return on your investment, but a higher risk.
Absolutely.
All right, your turn.
So what we have is we have this market of these loans that are higher risk, and this was kind of, I have to be careful here, not to get too political with it, but a big part of that was our government saying we need to make housing affordable for everyone.
Mm-hmm.
And the problem was if I went to Guild Mortgage and said, hey, as the government, we want you to do more of these high-risk loans, you're going to say, we don't want to. We don't want to hold that loan. We don't want to own it. We're willing to own it, but we want it in a limited capacity. And so what the government did was allowed the securitization, which means now I can take those loans, I can sell them off. Another company can take those and put them into it. You talked about mortgage-backed bonds. That's essentially what they did. Is they took these high-risk bonds and they packaged them into larger mortgage-backed bond instruments. And then my industry, being what we are, found this was a great way to money. So they make money. Quick money. They would package these things and sell them off. And the problem we had is that they took them, and there were a lot of insurers in the industry that said this is not as they rate different loans, it's
risk-wise.
They rate it A, AA, AAA. AAA being the highest. You get down into B and C, you're talking
which is subprime.
Subprime. And so they would take these loans and say, you know what, we're never going to be able to sell this on the market as a subprime mortgage, so we'll get this insurer to come in, and then we'll have a AAA rating on our bond, even though there's not anything in that portfolio that should be AAA rated. And then we levered that up enormously, 30 times. So for every dollar you had on your book, you had $30 lend out on it.
Oh yeah, wow.
And
monopoly money.
Pretty much. And that was all fine and dandy as long as everybody was paying their mortgage. What we found is that once the market fell apart and the risk side of that investment started to rear its head, nobody could value these investments anymore. There was no market for them. So I might have $2 billion worth of these on my balance sheet, and I can't liquidate them for any price.
No one wants them at all.
Nobody wants them at all. And what that did is it absolutely destroyed corporate America's balance sheets, because every large financial institution in America owned them.
They look like, hey, look at the high rate of return. So far, they had a good history for the whatever time they had.
They're AAA rated. Everything looks good.
Why not do these?
And so it completely fell apart. And what that did is it destroyed liquidity. And in the financial world, everybody lends to each other. And that's something I don't know that people necessarily understand.
I don't think they do. Give us a minute and a half on that.
So I work, Merrill Lynch I worked for Merrill Lynch. Merrill Lynch loaned back and forth with Morgan Stanley. Morgan Stanley loaned back and forth with Bank of America. Bank of America loaned back and forth with JP Morgan. We all owed each other money. It's a weird deal, but it's kind of how it works, and there's a lot of reasons for it. And what happens is if the idea gets out there in the market that you're no longer creditworthy, all those lines of credit are sucked up and they disappear. And so now
that's liquidity.
That's your liquidity. and that's how they maintain
Borrowed liquidity in a
borrowed
sense,
liquidity.
but that's how you buy and sell, buy and sell.
Exactly. And so what happened is, in the first one to fall was a company called, gosh, I can't remember their name now, Bear Stearns. And they had a couple of funds that they lost all the liquidity in. The word got out into the street that they were no longer credit worthy. And
Now, how important is that? Word got on the street.
it's critical, because that's everything.
That's everything.
That's everything. Is how
Your reputation.
Your reputation. And so whether or not they were credit worthy or not didn't really matter. The fact is that nobody else would give them money. Everybody said, you know what, we're calling that line of credit, and we're demanding our money back, which meant that suddenly Bear Stearns went from being very, very liquid and a great company to within a matter of days they were out of business because they could no longer fund their operations.
Because really, your industry moves pretty fast. This buying and selling thing, this liquidity thing is a constant.
Absolutely, daily.
You don't sit on inventory on the floor.
We don't. We act as an intermediary, and we used to carry a lot more inventory. We do now. We carry almost no inventory now.
You know what's interesting is that I'm going to say this and make sure it's right. So a lot of people, they own a store, they sell shoes, they sell clothes, they sell cars. You sell money, in a sense.
Absolutely.
Even though, and it's not actual, it's probable.
So it's and that's why people sometimes have a hard time wrapping their arms around.
That's hard to trust, isn't it?
It is, and that's and as we were talking earlier before the show, I said trust is the currency that we work with in the financial services industry. And so and that's what created it. So all these companies suddenly lost their credibility. America didn't trust them. They had no liquidity left, and suddenly we were in a real crisis in terms of is this company even going to be here tomorrow? And that's what led to Merrill Lynch being bought by Bank of America. It was that option, or we literally had about 3 or 4 days before we had problems.
So what you're telling me is, as much as you and I want absolutes in life and guarantees, there aren't any.
Very few. Death and taxes; those are the big ones.
Death and taxes, those two.
So,
and even though it could be a business that's around for a million years, and you trust your advisor and everything else, this could happen, and you have to be careful of it.
Yeah.
So we've kind of asked this question a few times, but I want to do it kind of a final. We've talked about what happened, why it happened. Hindsight's 20/20. What can I do, the best I can, to make sure that doesn't happen to me again?
Number one, coming back to the leverage deal. What applies in corporate America applies in our individual lives as well. Keep your leverage down. And again, as you
define leverage, in case someone didn't catch that.
Your debts.
Okay.
Try and eliminate your debts. Okay. Debt is one of those things that will always, always be there.
It's there.
It's not gone until you get rid of it. And it's particularly dangerous in retirement, where you're on a fixed income and you don't have the capacity to earn anymore. You can go get a job, but very few people after they've been retired for a couple of years have any interest in going back to work. And
likelihood of getting a well-paying job is not as high.
Yeah, and your earning power is pretty limited. And so, number one, keep your debts to a minimum to the extent that you can. And as you approach retirement, I really would recommend getting out, getting your house paid off. If that means downsizing, whatever, deferring retirement for 3 or 4 years till you can get that taken care of, whatever you need to do, just so that's one, you've got to keep your expenses to a minimum. And so that would be,
I guess you'd even have to realize that as you get older, you might have some medical bills.
Absolutely.
Other things pop up.
Yeah, things are going to change. And secondly, make sure you understand the risks associated with your portfolio. Because of inflation, we talk about risk in terms of volatility. That's where we typically, when people think of risk, they think about losing money. There's lots of other types of risks that are out there. Longevity risk is one that we're looking at now, which is the risk of outliving what you own. Statistically speaking, now a couple who's 65, there's a 45% chance that one member of that couple is going to live to be 90 years old. So when we retire, we really are looking at planning for 25 or 30 years. of being able to take care of
If
ourselves.
65 is used as
If you retire at 65,
Mm-hmm.
you know, the younger you retire, the longer that that number becomes.
If I retire at 50, then I've got to plan for a lot more.
And statistically speaking, that's a long time.
Mm-hmm.
And so make sure that you're prepared to do that, you know, and make sure that your investments, that you're minimizing the risk. You've got to plan for inflation. That's something that's out there. It's something that we mentally talk about every day, but we don't plan for. You know, how many times have, you know, this is a conversation we've had a million times over the last few years is the price of gas.
Mm-hmm.
You know, I was talking to a friend the other day. I said, I remember the last time I paid for less than $1 for gas is when I went up to Logan to see a friend while we were in college.
Mm-hmm.
You know, now we're paying $3 for gas
Or more.
And so inflation is something that we deal with, but we don't typically plan for. We need to make sure that our investments have the capacity to outpace inflation.
Is that 3 to 4%?
Historically, it's about 3.1.
3.1.
Right now, it's less than that. During the 80s, it was significantly higher than that. So it moves. It's kind of a moving target, but it's something we need to plan for and be aware of. You know, interest rate risk is another one. You know, in the 80s, you could buy a municipal bond, tax-free bond that would pay you 15%. On $1 million, you had $150,000 in income. Today, you can get a 4% coupon if you're lucky.
Mm-hmm.
And so now we're talking about what used to pay you $150,000 is only paying you $40,000 in income now. So
with higher living expenses.
With higher living expenses.
Sure.
And so those are all things that we have to be aware of and make sure that, and this is why equities tend to have to play into your portfolio a little bit, is they're one of the few investments that have the capacity to outdo inflation over time.
Mm-hmm. So what I've learned is that with all, we've just talked for an hour, by the way. Time flies when you're having fun.
Yeah, absolutely.
I've learned that each person's different.
Absolutely.
And it's up to me.
Mm-hmm.
And I need to get the best advice possible.
Mm-hmm.
And depending on what age I am. Now, by the way, one thing I learned today is to look at my 401k, my portfolio annually. I was thinking 5 to 10 years, which would be a huge mistake.
Mm-hmm.
Looking at it annually is a big deal. Starting out as a 401, starting out actually with a savings account, then a 401k, taking advantage of any contributions from the employer,
right,
and expanding when I'm 50 into diversifying as I go along the way, and at 65 and 70 and 80 and 90 even, being more conservative. But the overlying thing I've heard from you is get out of debt.
Mm-hmm.
With all the fancy words we just used today, that's the phrase that I heard the most. Is that true?
I think so. That has to be part of your plan. You know, it just is. And
if I'm not, so I'm at an age that I go, uh-oh, I guess I better come and talk to you.
Sit down and develop a plan for how that's going to happen.
Because you can change a budget if you want to. You can sell a house. You can sell a car. You can do things if that's your plan and you want to be able to retire in a situation where you're earning the money that you want.
Absolutely.
Well, we've been spending an hour here with Jeff Rasband. He's a vice president. Fancy title.
It is, yeah.
And financial advisor. Is that what financial advisor with Merrill Lynch. He's down in Utah County, lives here in Midway, is a native. Actually, you're a native, your dad's a native, your mom's a native,
yep.
Your grandparents are natives, and your great-grandparents are natives.
Absolutely.
I mean, they settled this place.
They did.
Hometown boy for sure. In fact, the hometown boy on the hometown radio station.
Yeah. In fact, this radio station is my great-grandfather's old home.
That's right. That's right. What was his name?
Heber.
His name was Heber. Boy, we've got the guy on our show today. That's for sure. You've been listening to 1340 KTMP. I'm Tom Stone, and it's been sponsored by Guild Mortgage Company. Now, Jeff, I have a fun time on my disclaimer. Everyone loves the disclaimer part of the show. They look forward to it, and I'm going to do it as fast as I can because how much they love it. So here I go. Guild Mortgage Company, NMLS 3274, Equal Housing Lender, Tom Stone, NMLS 257849. The information contained in this training has been prepared and distributed for educational purposes only and do not represent the opinions of Guild Mortgage Company. I have a lot of rules and regulations like you do.
Yep, they're fun. And
this radio show was approved only if I said that every single time. Well, again, Jeff, thank you very much. It's appreciated. My hope is that people listen to this. This is so critically important to have even some of this in a person's life, and I recommend talking to Jeff. He actually has my investments, and I trust him 100%. So thank you, and would you come back on the show sometime?
I'd love to. Absolutely.
We'll have you back sometime.
In fact, maybe something that would be nice is if there are questions that individuals have, if they want to send those over to you, maybe we could plan something down the road to do it again.
You know, I've offered that, and let me just remind people, my email address is tstone@guildmortgage.net, and I would love to receive questions that I can pass on to Jeff if you'd like to contact him directly, but your questions would be critical for a next show that we can prepare so that we can talk a little more specific about what's going on with that. So thank you again, Jeff, and we'll see you another time.
All right, thank you.